Hi, I'm Brian.
And I'm Anurag. Today we're excited to pitch NVIDIA, a dominant force not just in AI chips, but in an entire ecosystem, accelerated computing, graphics, and high-performance systems.
NVIDIA is more than just a chip maker. It's evolving into the infrastructure layer for next-gen computing. Our thesis is that even after a historic run-up, the market still undervalues NVIDIA's long-term growth, driven by secular trends in AI and cloud computing.
NVIDIA operates across four key segments. The first is data center, which is the largest and fastest growing division. It's powered by demand from hyperscalers, enterprise AI, and generative workloads. Second is gaming, which remains a strong foundation with continued demand for GeForce RTX GPUs and cutting edge rendering like ray tracing and DLSS. Third is professional visualization, which serves design and creative professionals through advanced rendering and simulation capabilities. And finally, automotive and embedded AI segment focuses on autonomous driving and edge AI, leveraging platforms like Drive Orin and Jetson.
What sets NVIDIA apart is its deep vertical integration. They don't just sell chips, they offer a full stack AI platform. Their proprietary software stack, which includes CUDA, cuDNN, and TensorRT, forms the backbone of modern AI development. This software dominance builds massive switching costs for developers and enterprises. Their latest hardware, the Blackwell architecture, is a leap forward, built to handle trillion parameter models and delivering up to 25 times better energy efficiency in AI workloads. Combined with their Grace Hopper superchips and the NVLink switch fabric, they can now scale compute workloads across thousands of GPUs with memory coherence and optimized performance.
In essence, NVIDIA has positioned itself as Amazon of the AI computing. They are underlying infrastructure for training, inference, and AI deployment at scale. NVIDIA's competitive moat is multi-layered and incredibly strong. First, their technology leadership is unrivaled. CUDA has been around for 15 years and remains unmatched in its maturity and ecosystem support. Second, their developer ecosystem is deeply entrenched. From startups to Fortune 500 companies, developers build, optimize, and deploy within NVIDIA's software stack. Third, their platform partnerships span across hyperscalers, Amazon Web Services, Microsoft Azure, Google Cloud, and Meta. They all rely on NVIDIA hardware.
The biggest differentiator is NVIDIA's software. While AMD and Intel are competitive in raw hardware, they lack the robust software stack that NVIDIA offers. This gives NVIDIA a sustainable advantage in customer retention, margin structure, and innovation velocity. NVIDIA is also pioneering new business models. Through DGX Cloud, they're delivering AI as a service, enabling companies to train and deploy large models without managing their own infrastructure. Their NVIDIA AI Enterprise Suite enables recurring software revenue, and their Omniverse cloud platform expands their reach into digital twins and industrial metaverse.
And the total addressable markets continue to grow. AI infrastructure alone is projected to surpass 400 billion by 2027. NVIDIA is strategically positioned to benefit from both capital expenditures through selling GPUs and systems and operational expenditures through AI services and subscriptions.
Let's turn to financial performance. NVIDIA generated $60.9 billion in revenue in fiscal year 2025 alone. That's a staggering 126% year over year increase, driven largely by growth in their data center segment.
That segment alone contributed 47.5 billion, more than quadrupling from the prior year. The surge driven exponential demand for computers, especially for training and deploying large language models. Gross margins expanded to 78.4%, reflecting NVIDIA's premium positioning, scale, and software-enabled differentiation.
EPS came in at around $17.26, up over 160% year over year. Operating cash flow reached $28.1 billion, enabling NVIDIA to invest aggressively in R&D while also returning capital to shareholders. The company maintains $30 billion in cash and equivalents and carries virtually no long-term debt. This gives them the strategic flexibility to withstand macro shocks and continue reinvesting throughout the cycle.
NVIDIA's financial discipline is also impressive. Despite the surge in revenue, their operating expenses have scaled efficiently, allowing them to maintain high margins and profitability. This reflects a strong culture of cost control and capital discipline.
Now let's address valuation. At first glance, NVIDIA may appear expensive with a trailing PE ratio of around 65 times, but on a forward basis, factoring in strong earnings growth, the multiple drops closer to around 32 times.
To assess fair value, We use two models, a discounted cash flow and a supernormal dividend discount model. In our DCF, we assume 35% revenue CAGR over the next 5 years, with EBIT margin stabilizing at around 55%. We use WACC of 9.5% and a terminal growth rate of 4%. This gave us an intrinsic value of about $386.60 per share, suggesting approximately 20% upside from current levels.
In our dividend discount model, we modeled a 10-year high growth dividend phase, tapering to a 5% terminal growth rate. Even under conservative assumptions around payout ratio and growth, the DDM yielded a fair value north of $486 per share.
So even after a historic 200% rally, NVIDIA remains reasonably priced for long-term investors, especially if you believe in AI as a generational trend. Naturally, there are risks to consider. The first is customer concentration. NVIDIA derives a large portion of its revenue from a few hyperscalers like Amazon, Microsoft, and Google. Second, there's geopolitical exposure. Export control from China could limit growth in the data center sales. Third is competition intensifying. AMD's MI300X and Google's TPUs are credible challengers.
However, NVIDIA mitigates these risks in several ways. Their global customer base spans cloud providers, enterprises, and research institutions. Their software stack creates IP differentiation and strong customer lock-in. And their $8.7 billion R&D investment in fiscal year 2025 ensures that they remain at the cutting edge of both hardware and software innovation.
Importantly, NVIDIA is transitioning into recurring software revenue. NVIDIA AI Enterprise, Omniverse, and cloud-based APIs provide stability and reduce reliance on hardware refresh cycles. They're also proactively engaging with regulators and diversifying their supply chain to mitigate geopolitical and trade risks.
Let's take a strategic look at NVIDIA's position using Porter's five forces. Starting with the competitive rivalry, it's high. NVIDIA faces strong competition from AMD, Intel, and internal silicon efforts at cloud companies like Google. The space is innovation heavy and fast moving.
Next, the threat of new entrants is low. The capital intensity, IP barriers, and ecosystem lock-in make it incredibly hard for new players to enter the space. On supplier power, we would say is moderate. NVIDIA relies on TSMC for advanced nodes, which gives TSMC leverage. But NVIDIA's scale and strategic importance gives it some counterweight.
On the buyer side, power is moderate to high. Hyperscalers are large customers and can negotiate aggressively, but NVIDIA's integrated stack and performance advantages reduce switching incentives. Finally, the threat of substitutes is low to moderate. Custom chips like TPUs do exist, but they lack the ecosystem and software maturity that CUDA provides.
Overall, NVIDIA's strategic position is strong. They face intense competition, but their ecosystem, innovative velocity, and customer entrenchment keeps them in a leadership position.
In conclusion, NVIDIA is not just a hardware company. It's the backbone of the modern AI stack, spanning training, inference, cloud, edge, and software. Its combination of technical leadership, financial strength, and long-term vision makes it one of the most important companies in the world.
The fundamentals are explosive, the moat is expanding, and the valuation is still reasonable when you factor in earnings growth and optionality in new business lines.
With this, we're initiating a buy rating on NVIDIA with a 12 to 8-month price range target of $378.98 and a long-term bull case of over $418 per share.
Owning NVIDIA today is like owning Intel in the early 90s or Amazon in 2010, except with a bigger addressable market, faster growth, and better margins.
Thank you.
Thank you.